Okay, so this is the second part 2 of our discussions on bank and insurance companies' asset liability management considerations. Just to revise part 1, we discussed that as compared to pension funds, endowments, foundations and sovereign wealth funds, banks and insurance companies have committed measurable liabilities and they survive on the basis of assurance that those liabilities shall be met. So accordingly, their assets have to be managed in such a manner that the liabilities are met. You cannot apply asset-only approach. You have to apply LDI, liability-driven investing. Then we discussed that basically the risk of equity in a bank, the risk faced by equity shareholders in a bank is a function of 4 things. Number 1, the risk of asset. Number 2, the risk of liability. Number 3, the correlation between the two. And number 4, the leverage used by the bank, leverage A by E used by the bank. Okay, we would wish that the correlation between the assets and liabilities is strong. So when the assets goes up, that time liability goes up. When the assets goes down, that time liability goes down, such that they offset each other. And whatever is the volatility of asset and liability, they will be amplified by the leverage used by the bank. So accordingly, the bank should try to maintain lower amounts of leverage. Okay, it is time immemorial proven that any bank pursuing a strategy of excessive leverage has seen times where it was not able to face the consequences of hard times because of too much of leverage used. The best of companies have cracked up, okay, whether in the financial sector or otherwise. In India, we find that Reliance, okay, went aggressively for becoming net debt free. Okay, and the market gave a thumbs up to it. So leveraging is something which is really understood by the entire world. It's a very risky thing. You should use limited amounts of leverage, especially in businesses like banking or insurance, which are anyways fraught with a lot of business risk. Okay, so that's what we had discussed. There were 2 equations that we had done. What were the 2 equations? The one equation was regarding duration of equity. So which means we were trying to capture interest rate risk with the help of duration. We know that is, first of all, interest rate risk is not the only risk faced by banks. There are multiple types of other risks faced by banks. And secondly, interest rate risk is not captured by duration. It needs convexity, it needs optionality feature, but still for a simple intuitive model. So duration of equity equal to duration of asset into A by E. Look at the way in which we are scaling up duration of asset with A by E. So duration of asset is 7, but A by E is say 5. So 7 into 5, 35% is the effect. Minus offset by DL into L by E. Now I personally wanted the equation to be this only, but they gave an additional factor over here, delta I by delta Y. Okay, I think this was the notation. So delta Y is the change in asset yield, delta I is the change in liability yield. So if this ratio is provided to you, it may be provided as a statement that for every 100 basis point change in asset yield, liability yield will change by 80 basis point. So delta I by delta Y is 0.8. Understood? So this was one equation, and I tried my level best to ensure that when you do this, it doesn't seem that you are putting and getting the answer. It should be there in your mind. Assets duration into A by E, liability duration into L by E, into delta I by delta Y. Very easy. I tried my level best. And the second equation goes into all the risks faced by banks, and that was sigma E equal to square root of A by E, the whole square. It's like weight square into variance of assets. This also is written this way. Plus L by E, the whole square. It's like weight square. Okay, the Markowitz formula. Into the variance of liability and minus 2 into weight A by E into L by E into covariance. So into R into sigma asset into sigma liability. So what happens is that when concepts are mathematized with equations, it becomes further reinforcing. So I started by saying that the risk of equity depends upon the risk of assets. Here you have it depends upon the risk of assets. Number 2, it depends upon the risk of liability. Here you have the risk of liability. Number 3, it depends upon your correlation, okay, you can write a correlation symbol, the population correlation, and it depends upon the leverage used by the bank, okay, the leverage used by the bank, number 4. So these are the 4 things on which the risk of equity will depend, correct? So we went on practicing examples on these 2 portions again and again on the Calci. I tried to ensure that 2 things you always use in your study style. Number 1, the concept should be clear, okay, 100 times clear in words. If you can't speak in words, you don't know it. You can't explain to somebody else, you don't know it, okay. I know it, but I can't explain. That means you are not clear about it. And number 2, I don't like equations to be mugged up and to be put and get the answer. That's not the style we do. We tried to do it with numbers. So I did a lot of number crunching last class. I will not duplicate it today. Okay. If somebody has not watched the part 1 video, please go and watch the part 1 video, then come to part 2. Now, I had, along with the part 1 video, shared a PPT and I had shared Excel sheet with you. Okay. Now, they have, for the first equation, that is duration of equity equal to dA into A by E minus dL into L by E into delta I by delta Y. Now what they have done is, suppose they took a certain dA, whatever, they took a certain dL, they took a by E, and they took a delta I by delta Y. Now this is freezed, this is freezed. And these 2 are changing, dA and dL are changing. So dA and dL are changing at a certain A by E, at a certain delta I by delta Y. What is happening to the duration of equity? Duration of equity, you understanding? If duration of equity is 27, it means if interest rate goes up by 1%, equity will fall by 27%, correct? So by changing dA and dL, we are understanding what will happen to equity. Please be prepared without looking at the Excel sheet. Sir, if duration of asset is more than duration of liability, already assets are more than liabilities, so asset in the formula dA is multiplied by A by E. Have a look. Okay, let me just mark it and show it like this. dA over here is multiplied by A by E. Can you see this? While dL over here is multiplied by L by E. So dA is multiplied by bigger amount A by E. dL is multiplied by L by E. So if duration of asset is higher and multiplied by A by E, bigger, duration of equity will be mammoth, correct? Similarly, if dA is equal to dL or dA is slightly less than dL, I would prefer dA slightly less than dL, maybe duration of equity will be 0. Duration of equity will be 0 if dA is equal to dL. That's what the author has written. I would want dA to be slightly less than dL, because since A by E is greater than L by E, dA should be slightly lower than dL. But that's not what the author has written. So author says if you are matching the duration, rest assured, you don't need to worry, because if interest rate goes up, assets will fall, liabilities will fall, they will cancel off each other, equity will be unaffected. Okay, so you know the theory beforehand, and look at the Excel sheet. I am showing the whiteboard version of the Excel sheet so that I can write and draw. The Excel sheet is already shared with you. Once again, we are attaching to this video. Okay, so look at this. So over here in this particular column, I have taken dA. Okay, I'm showing it to you. This is dA, and over here is dL, correct? Asset by equity, I am playing with it. I have taken 5 in this particular screenshot, but as you can see the play button over there, I can increase it to 6, 7, 8, 9, 10. Okay, so I have taken 5. 5, you are understanding? Equity to asset is 20%, because the institute questions generally give you the equity to asset ratio, the equity capitalization, the equity to asset ratio is say 20%. So 1 by 0.2 is 5. We did questions to that effect. DI by DY, for the purpose of simplification, I have taken it to be 1, because what's the sense in trying to play with this? So I've assumed that asset yield and liability yield will change by the same amount. You can change it. The open version of the Excel sheet is shared with you. Please do play with it. Okay, so that you understand more. So then I applied the formula and got all the figures inside the matrix. It's a 20 into 20 matrix because I started with DA, okay, from 0 to 10, DL from 0 to 10 and 0.5 intervals. So it's a big matrix, and these figures inside have been calculated by that formula, DA into A by E minus DL into L by E, the whole into delta I by delta Y. Let me not waste time to show how the Excel is prepared. Okay, you are smart enough for that. Now then, there is a diagram prepared in the core. This diagram is prepared. So Excel is not required for the exam. This diagram may also not be required for the exam. But since they prepared this diagram, a student who is a perfectionist would be feeling incomplete if he doesn't understand what's happening over here. So this is a 3D graph. This is a 3D graph. Obviously, this is representing DE, duration of equity. Duration of equity. Okay. This is a duration of equity. Now, if you look at this, this is duration of liability. This is duration of asset. Duration of liability, duration of assets. Now, basically in the diagonal, if I draw a diagonal over here, you will find that we are close to 0. Are we? Yes. That means in this diagonal, DA equal to DL. Therefore, DE, I am writing approximately equal to 0. Perfect. Asset liability matching. Because it's LDI, no? So the bank is matching its asset duration with liability duration such that equity is immunized. Whatever fluctuation takes place in the asset, it is made good on the liability side and equity is immunized. Now, if you look at this side, let me draw another one. So I'm drawing another diagonal over here. And what's happening over here is that over here, DA is greater than DL in this entire portion, the red portion above the black line. Therefore, DE is positive. In fact, if you want to see DE greater than 0, if you want to see, let's see in the same, the duration of asset over here is 10. Have a look. This is 10. And the duration of liability is what? 0. Can you see that? And what is the duration of equity? The duration of equity is 50. It's 10 into 5, the formula. Okay, what was the formula? The formula was DE equal to DA into A by L. So this is 10 into 5 equal to 50 minus 0 because duration of liability is 0. So that's the maximum duration of equity, 50%. Very bad. You are having extremely short-term liabilities with 0 duration and you are funding long-term assets with it. You are trying to ride the yield curve, but if interest rate goes up, you'll be gone. Okay. On the extreme side over here, we have DL greater than DA and therefore DE is negative. DL is more than DA. You can once again look at the Excel. Over here we have DA equal to 0. Can you see my hand symbol? And DE over here is 10 and you have DL equal to minus 40. Somebody imagine, sir, why minus 40? Last time it was 50 because DL is multiplied by L by E. And you know L by E is A by E minus 1. So 4. It's 10 into 4 minus 10 into 4 minus 40. Of course, you know what a negative duration means. It means if interest rate goes up, equity will gain. Why, sir? Because if interest rate goes up, our asset duration is 0, not affected. But liability will fall. Liability will fall by 40%. Therefore, equity will rise. Okay. So you should not accept maths. Think about the balance sheet again and again. In this minus 40, what is happening? Asset, liability, equity. If interest rate is going up, asset no change, no change. And liability is going down by 40%. So therefore equity is going up by 40%. So you should not accept anything mathematically. We are not specializing in mathematics when doing the CFA program. We are specializing in logic, in applications. Okay. So you can practice the Excel sheet if you are interested. That's how the diagram is interpreted. I have also given one more Excel sheet. This is by taking asset by equity equal to 10. So this time, when DA is 10 and DL is 0, 10 into 10, 100. Let's look at 10 into 10, 100. And when DA is 0, DL is 10. 10 into 9, 90 minus 90, is it? Yes, it's minus 90. And you see the plane is more falling over here. Okay, it's the same interpretation. So you should not feel that I cannot interpret a 3D graph. A 3D graph got to be interpreted properly. Okay. However, if you ask me, sir, do we have any incremental knowledge from all this as compared to what we were having when you were discussing it without the graph, I will say no. No knowledge. And sometimes by looking at the graph and the Excel, you are less knowledgeable from a business sense point of view as compared to otherwise. So please consider them to be subservient. The main thing is your concept. Duration of asset should match with the duration of liability. And if it does not match and leverage is high, then the DE, duration of equity, will be significantly different from 0, and that means interest rate changes will affect equity significantly. The bank's shareholders are extremely exposed to interest rate risk. What happened in India in ILFS, they started funding their assets with commercial paper, trying to write the yield curve, and interest rates shot up and everything collapsed for ILFS. Of course, there were other corporate governance issues over there also. Okay. Now, they've also given a graph to explain this, okay, sigma E, wherein they've tried to explain that if we have correlation over here, correlation, say moving from, if I say -1, if I take this axis to 1, so in that case, if the correlation between asset and liability is higher, can you see this? Correlation between asset and liability is higher. That means the nature of the assets and liabilities are matching. If this is higher, the minus part is higher, the risk of equity gets reduced, na? Okay. So they have shown that as we move towards this, the risk of equity will go down. But they've drawn different graph for it. This is high A by E. A by E is high. Over here, A by E is low. Once again, do not bother with the graph you want me to show you. I'm just showing you. Just 1 second. Okay, you want me to show you. I'm just showing you. Just 1 second. Okay, so let me show you. Here we have the PPTs that I had shared. Yeah, this is the graph. Okay, this is the graph that you have. So this is the graph that you have. So as the correlation is moving from -1 to +1, as the assets and liabilities are more related to each other, you find that, okay, the volatility of equity is falling. Now we know this. It is not that by looking at the graph, oh, now I understood. No, it shouldn't happen. And this is much simpler to prepare. You can take sigma A, you can take sigma L, you can take A by E. A by E -1 is L by E. Okay, and you put them in that equation, root over. You put them in the equation, you'll get sigma E as a function of R. Sigma E as a function of R. Now change R from -1 to +1 and you get a particular curve. You take a different level of A by E, say lower level, you'll get the curve below it. Okay, so it's very simple. I have not shared the Excel sheet for this. Okay. Just 1 second. So fine, let's use it further. Okay, now there's a section given on, there is a portion given by the Institute on investment strategies and effect on bank insurance assets and liabilities. Investment strategies and the effect on banks' insurance assets and liabilities. This big exhibit is given. I'm showing you the bigness of the exhibit. So there are 2 investment strategies on this slide. Now there are 3 on this slide, a further 4 on this slide, and 3 on this slide. So 12 investment strategies are given. These are very simple. It would be heights of stupidity if I were to read this for you. For example, I start reading diversified fixed income if I start reading diversified fixed income securities, obviously sigma asset will come down. Okay, they've written debt securities are less volatile than common equity, real estate, other securities, and additional consideration, effective diversification involves some multiplicity. So if I just read it out, what am I doing? We got to command. We are not supposed to follow the slides. We are supposed to command the slides. So let me explain how do we conquer this. Okay, let me explain how do we conquer this. Just 1 second. Let me come to it. Okay. So I will just open a whiteboard slide to explain to you nicely. Okay, listen. The discussion is investment strategies. Very, very important. You will struggle over here. I'm telling you, you will struggle. So please listen to it carefully. Sigma square E is equal to A by E the whole square. Sigma square A, I'm not writing delta A by A, please pardon me. Plus L by E the whole square into sigma square L minus 2 into A by E into L by E into correlation into sigma A into sigma L. Correct? Okay. This means our sigma E is a function of sigma A, correct? Sigma L, correct? Correlation and A by E. And a student who has listened to my class part 1 will feel that I had started with this. Okay, the volatility of equity depends on the volatility of asset, volatility of liability, correlation and the leverage used. Correct? Okay, now let's think. We want to reduce sigma E. We want to reduce sigma E. So what do? We should reduce this. We should reduce this. We should increase this. And we should reduce this. Are you okay? If a bank wants to reduce the risk faced by its equity shareholders, it should reduce the volatility of asset, volatility of liability. It should reduce the leverage, okay, by raising more equity capital, and it should raise the linkage between asset and liability so that they offset each other. First understand this, please. I hope you're okay with this. And you would always be okay with this, provided you don't allow the author and the book to dominate. Every good author who has written a tremendous book is not the best teacher, because they know how to write the book. They don't know how to explain to the audience. Okay? They many times write the book as if they are telling, not teaching. Okay? But we want teaching. So you try to dominate the author. To reduce the volatility of equity, we need to reduce 3 things: volatility of asset, volatility of liability, the leverage, and to increase the correlation. Now let me discuss one by one. Hope you are copying, because I'm not dictating. Normally in class, I dictate all this. But over here, since I'm discussing this video on YouTube, I'm not dictating because nobody will have the patience to take down the notes. Okay? Level 1, level 2, I think dictation helps a lot. I've seen it. According to my personal experience, when we dictate in a summarized manner, the retention level is 100 times. But in level 3, people are sophisticated. Okay, we believe that they can manage with the help of explanations. Okay, so now let's come to the first part. A by E should be decreased, correct? That means raise equity capital. So those banks who have such a strong brand that we know whenever they raise equity capital, markets would say thumbs up, they will be ready to supply. So if the bank is having such a great brand that it can raise equity capital whenever it wants, I like to invest in the stock of that bank. In India, the PSU banks, the likes of State Bank of India, Punjab National Bank, Bank of Baroda, they are in pathetic situations, especially because of coronavirus. And they had been recapitalized just 2.5 years ago. And there was a massive spike in the share price at that time. And anybody who is trading or investing in markets in India knows that it seems that all these banks are once again going to be recapitalized, resulting in a further rise in equity. Because for PSU banks, they don't have the brand, believe me, they don't have. SBI does have, but other banks, PNB, Bank of Baroda, don't have the brand. So they are recapitalized by the government, as in taxpayers' money. And then their price shoots up for some time and then once again falls. Because they are just tactical moves that people like us design that, okay, we know that this is going to happen. When exactly, we don't know. So raise equity capital. Second point I would like to mention is that there is something called equity to RWA, risk weighted assets. You must have heard this, because all the assets on the asset side of the balance sheet do not carry the same amount of risk. So when the regulators, they demand the bank to keep say 10% of their risk weighted asset as capital. Suppose risk weighted asset, whatever it is, 10% of that got to be your capital. So risk weighted asset, if we can reduce it. How do we reduce risk weighted assets? If our assets are such that regulators attach a lower risk weight to them, okay, they attach lower risk weight to them, in that case we can reduce the risk weighted assets. Example, if you hedge your asset exposures with plain vanilla derivatives which are collateralized. Okay, suppose for example, a bank has fixed rate debt securities, So we know fixed rate debt securities have a high duration. Now number one, the bank wants to reduce the duration of the assets. Okay, and number two, it also wants to decrease RWA. So if the bank enters into a plain vanilla receive floating pay fixed swap, are you understanding? The bank is having fixed rate debt securities. It enters into a receive floating pay fixed swap. So it will be receiving fixed, paying fixed cut. Now it has converted it into a floating rate asset. Obviously duration has come down, but the best part is it did the same with the help of a plain vanilla derivative. Plain, not an exotic derivative. Okay, plain vanilla derivative is easy to offload from the books. It is easy to offload from the books. If you enter into exotic derivative, the liquidity of the derivative is low. Okay, so regulators like that you are hedging with derivatives which are plain vanilla, which are collateralized, which have less counterparty default risk. Okay, so all that can be done for the purpose of ensuring that your A by E goes down. Okay, and so I've written two ways over here. Correct? You may copy that down. Okay, now next. So sigma A, let's discuss sigma A now. So our assets, I mean to say investment assets, the investment portfolio, fixed income, equity, AI, within fixed income, floating, fixed, within this treasury, high rated, low rating. Okay, treasury, high rating, low rating. Diversification. When we say diversification for a bank globally, across maturity, across currencies, across sectors, across industries. Okay, that is the true diversification. So if a bank is allocating, if a bank's investment portfolio is allocated more towards this, say 70% towards this or 80% towards this, less to equity, negligible to AI, okay, in that case obviously risk of asset will come down. If it is allocated more towards floating, risk of asset will come down because normally the liabilities of the bank may be floating. So if you're having floating assets, you are linking them up, correlation will also go up. And if you put in treasury, obviously you are high rated. Once again, volatility of asset is less, there is less credit risk involved. If you diversify, once again volatility of asset will come down. So if they are writing this as 5 points, we are not going to be subservient to them now. We are going to dominate them, not follow them. Okay, so you may check, this is what they have written. I am never a teacher who reads from the core. Okay, I will command the core. Okay, of course I'll follow the author because I know I'm teaching for the CFA program. So whatever vast knowledge I have, I will not try to impose myself. I'll try to teach according to the author. That's my hard work at home. Okay, but ultimately I will not read the core in front of you. You are supposed to read it yourself. If a bank invests heavily in equity, if you're investing in equity, in that case equity has a high volatility, sigma A will rise. In fact, the correlation will fall because equity will not have a correlation with the liability side, which are more contractual fixed income types. So investing more in equity for a bank is like increasing the volatility of asset and reducing the correlation between the asset and the liability. And AI is too illiquid for the bank to invest. So banks do not go into AI. So I think I have managed the asset side pretty well. Correct? So now let's come to liability, sigma L. Okay, we come to sigma L. If a bank wants to reduce sigma L, okay, you want to reduce sigma L, how do you reduce? Less catastrophic risks. So insurance company has written less policies on catastrophic risks because catastrophic risks are massive. Okay, an earthquake or hurricane or whatever, fire, if it just sweeps, there's so much of risk involved. And if it is not hedged via derivatives, say cat bonds, or not hedged via reinsurance, the market is not comfortable. They know that if that it related to a particular geography, big amount exposure, then the entire insurance company can collapse. Number 2, surrender penalties. All of you are aware that if you are having a life insurance policy, it has a surrender value. So you may surrender the policy and take whatever surrender value is there. When do you do that? When interest rate goes up. If interest rate goes up, you feel like taking your money and investing it elsewhere. So what happens is that when interest rate goes up, that time for the bank, the present value of the liabilities will come down, which will benefit equity. But if people surrender their policies, the bank will not be able to enjoy the fall in equity, the fall in liability and the rise in equity. Are you understanding? Bank has a certain liability issued. Now when interest rate goes up, the present value will fall, liability will fall, equity will rise. But if they surrender the policy, the present value at all will not happen. So bank is not able to enjoy the rise in interest rate by way of fall in liability. So bank can impose surrender penalties. If you surrender, you will not get the fair value. You will get lesser than that. Of course, how much easier it is to do that, that depends upon how much competition the insurance company is facing. Okay. I'm linking things up. Variable annuities. Variable annuities. So if the bank is issuing variable annuities or insurance company is issuing variable annuities, okay, which are related to equity markets, related to fixed income indices, related to commodity markets. So in that case, the liability side is trying to mimic the asset side. Normally we make the asset mimic the liability. Here the liability is mimicking the asset because the assets are invested in equity, fixed income. So if you are issuing annuities, the amount of which will depend upon the equity indices and fixed income and whatever. So indirectly you are trying to increase the correlation. That's very good. And then the sigma A, sigma L doesn't matter. You're increasing the correlation. Understood? So this is how you can do that. Okay. So you may now read that write-up which is given and you'll be more or less satisfied that yes sir, now it is under control. It's not that you have to mug up the 12 points, but when they come up, your mind should run. Okay, when they come up, the mind should run. That's investment strategies portion, which I've explained. Command, do not follow. Try to command. Okay. Okay, now, next discussion is on implementing. Okay, you can write the heading implementation. Now, as far as implementation is concerned, the author has said that there are two things. One is FM and the other is PM. I also mentioned this. I was using the word in the first class, business decisions and portfolio investment decisions. So financial management to be taken by the CEO, by the board of directors of the company. Portfolio management decisions to be taken by the CIO, the chief investment officer, the portfolio manager. So the asset liability management of a bank is not the duty only of the portfolio manager. It is the combined duty of the management, the board of directors, the FM part, financial management, and it is the PM part. What can the portfolio manager do? So it is a dual responsibility. You have to understand. And this is a function of competition that the bank is facing, because if all other banks are engaging in moral hazard practices, taking too much of risk. See, what happens in the banking system is that, suppose a cement firm fails, other cement firms are happy that the competitor has failed. But if a bank fails, other banks are not happy, because there's a systemic risk. Overall, the trust in the banking system goes down. So you have to see how banks are behaving. Competition, regulations, which is always in a state of flux, dynamic. Okay, own equity and debt valuation. How market is valuing the bank's equity and debt. So all that has to be considered apart from interest rate, yield spread, credit spread, okay, equity market, GDP growth rate and all that, market risk. Apart from all that, you also got to look at all this. Okay, they have said, how will FM and PM operate? What are the rules? Impossible. It is such a complex scenario. The asset liability management of banks and insurance companies is so complex. We cannot put down rules. All the Basel norms do put down a lot of rules and guidelines. Here this author has written, no, I can't write the rules. I am going to explain to you the gist of the rules via mini cases. I am going to explain to you the gist of the rules via mini cases. So given short cases, 4 cases, mini case A, B, C, D, we'll try to explain what type of questions we will expect in the examination. Because see, last class, the examples that we took were numerical. Numerical is easy, it's not important that way. But the theoretical, where you have to give a judgment, they are more important. So 4 mini cases given, they are utmost important. Okay, they are utmost important. I cannot emphasize how much important they are. Okay, just one second. So if I come to the 4 mini cases, yeah, this is mini case A. This is mini case A. So I'll do all the 4 mini cases with you. Usually I am not supposed to read. I can just explain that I have read, this is what is given. It will save time. But over here I would like to read. Why? Not the answer, but the question. And then discuss the solution. Because the language sometimes is very tough. So over there you have to read the language and interpret the same. So if I do not read with you, I will not be doing justice. It doesn't matter if I have to invest more time over here, but I want to do this very thoroughly. This is a very, very important section for the exam. This entire banks and insurance company ALM. This is probably given that it will come in the exam. Okay, nobody can guarantee, but please focus on this portion. And if you focus on this portion, the normal bank and insurance IPS part which is given becomes much more easier. Okay, this is the main stuff. That is subset of this. Okay, believe me. Let's look at the first question. A bank considers reducing its ownership of commercial loans in smaller businesses. So bank has given loan to small businesses. It has given loans. It wants to reduce the exposure. Okay. These loans pay interest quarterly at various contractually pre-specified spread over the floating market reference rate MRR. So these are floating rate loans. MRR plus spread. So please understand carefully. They are commercial loans. They have credit risk. They are illiquid. They have credit risk. And they are floating rate loans. Duration is low. Are you getting? Okay. These loans are commercial loans. Sir, there is credit risk involved. These are loans, not bonds. Therefore, liquidity is not there. And these loans are floating rate loans. Duration risk is less. Very important to focus on these 3 things. Credit risk is there. Liquidity risk is there because liquidity is not there. Okay, so liquidity risk. But duration risk is less, negligible because floating. I hope you will do it with that dig in when you do this. The runoff of the loan portfolio through repayments together with proceeds of outright sales and securitization of other loans are to be, I read it fast, the runoff of the loan portfolio through repayments together with proceeds of outright sales and securitization of other loans. So, they mean to say, how does the bank reduce the exposure to loans already given? Perhaps it will encourage the loan takers that if you repay, okay, we will give you some discount, say 5% discount. You are supposed to repay 100, please repay 95. So there will be some repayments. Plus they will securitize, okay, so they'll sell it off to some SPV and get the money, okay. Are to be, what will happen of that money? Are to be reinvested in a portfolio of fixed rate government securities of comparable maturity. That money is invested in fixed rate government securities of comparable maturity. So now we have government securities instead of commercial loans given to small businesses. So credit risk is coming down, credit risk is coming down, liquidity risk is coming down because government securities are extremely liquid, but they are fixed rate securities. Since they are fixed rate securities, duration is going up. Interest rate risk is going up. Are you clear? There are three elements. So what about duration? So duration is going up because floating to fixed. What about credit risk coming down, getting killed because we are going for government securities? Number three, what about liquidity? Liquidity risk is coming down. Liquidity of the bank is going up. Okay. So regulators will like the credit risk going down. Regulators will like the liquidity going up, but regulators will not like the duration profile going up. Okay. DA is going up. The securities will be hedged fully against general interest rate risk through the use of publicly traded options and futures on government securities. Oh, so I was wrong. So they are saying that the duration risk that is taken by buying fixed income securities, they are going to hedge it by using options and futures on government securities. What options and futures? Please think about it. Because we have done fixed income now. So obviously they will sell T-bond futures or T-note futures they will sell. Okay. Or they will enter into a pay fixed swap. What swap? Pay fixed swap. Fixed is coming in, fixed is going out. Or they're saying options, pair swaption. They'll buy a pair swaption. Pair swaption, as you know, is an option to enter into a swap as a fixed rate pair. Okay. So they'll use swap or options or futures for this. So when you read this portion, there is no sense in rushing ahead, because if you are rushing ahead over here, how will you do the fixed income portion? How will you do the derivative portion? You think this will come, this will not come. A holistic knowledge will be tested in the exam. So dig inside the language and don't leave it. Okay. In my last 25 years of career teaching finance, I've always taught to students that when you read something, study something, think that this is going to come in the exam. This knowledge is going to come in the exam. Do I know it? If I don't know it, I'm not supposed to turn forward. I'm supposed to stop over here and really kill it and then move forward. I'm going to research on Google, ask my tutor, ask my training provider about it, and I'm going to ensure that I know it in and out. Okay? Additionally, hedging interest rate risk completely would create a synthetic variable rate asset. He's explaining that look, we went for fixed, but we are converting it, so we once again have floating. So floating, duration profile same, floating, duration profile same, liquidity risk comes down, credit risk comes down, the bank is much more safer, is what I can see. But the disadvantage is that the earnings of the bank will fall, because the yield which was there on commercial loans, the spread on the MRR, the yield which is there on government security obviously is less. So you are having a situation where risk has come down, return has also come down. Not a surprise. Risk has come down, return has also come down. Correct? If interest rates rise, gains on hedges can be reinvested to raise portfolio income. They're trying to explain, you know, if interest rate goes up, okay, interest rate goes up. So in that case, the T-bond futures that we have sold will gain on it, and that will make good the fact that we will lose on our fixed income this thing. If interest rate falls, losses on hedges, losses on short T-bond futures will require some assets to pay counterparties, thereby lowering overall portfolio income. There is no sense in reading this part. They're trying to explain the meaning of the hedge. We have understood. So floating, no duration change, credit risk reduced, liquidity enhanced, but income will come down because now we will earn the yield on government securities. Earlier we will earn the yield on corporate small business loans. Okay. Question number 1. How would this portfolio restructuring affect the asset liability profile of the bank? Asset liability profile means duration profile. Very important. Asset liability profile means a duration profile. Would it be affected? No. Duration profile will remain the same because floating is replacing floating. So how will we write the answer? The answer has to be written in 2 steps. Step 1. Floating commercial loans were replaced by fixed government securities, therefore duration went up. Language number 1. Floating commercial loans were replaced by fixed government securities, therefore duration went up. First part. Step 2. However, the resultant fixed government securities were converted into floating via derivatives, that is options and futures. So we have floating government securities. Step 3. So floating commercial is replaced by floating government securities. Since both are floating, therefore duration profile remains what? Same. Do you have to mug up what the author has written the answer? No. I told you last class, it is the substance which matters, not the text. So many people whose English language is not that elegant, they tend to feel diffident when they look at the institute's answer. Please do not think about the substance. Don't think about the write-up. Okay, so this is a 3-part answer. Step 1, we replacing floating rate with fixed, therefore duration goes up. Second step, no, we are hedging the fixed rate government security with the derivatives, options and futures. So once again, we come to floating. Step 3, therefore, floating commercial is replaced by floating government security. Both are floating, duration profile remains same. Full marks, sure. Number 2, what is the expected impact on the volatility of the bank shareholders' equity valuation? What is the expected impact on the volatility of bank shareholders' equity valuation? Now this is on the volatility. Volatility will come down. Why? Because credit risk has come down and liquidity risk has come down. Credit risk has come down, liquidity risk has come down. Therefore, volatility will come down. Full marks. Credit risk down, liquidity risk down. Therefore, volatility has come down. Okay with you? Perfect. Third, what is the likely impact on banks' earnings? Down. Why? Because instead of earning the yield on commercial loans, we are earning the yield on GSEC. Okay? So, the bank's earnings will fall. The bank's earnings will fall. Clear? Number 4, what are the reasons that argue in favor of portfolio redeployment? So he's trying to say, as per the answer to question number 2, risk is coming down. As per the answer to question number 3, return portfolio, the bank's income is going to come down. So you have lower income but lower risk. If you are saying that lower risk will win, please build a case for it. Why? So the case is that number 1, the bank's equity capitalization, that is the bank's equity to risk weighted assets, will go up. Why? Because risk weights will be lower for government securities. Okay, hedged via plain vanilla derivatives. So the risk weight of the commercial loans is very high, but the risk weight of government securities is very low. So the RWA comes down, so the bank's leverage comes down. The bank's leverage comes down. That's one case. Are you understanding? I told you the equity by RWA. So RWA risk weight of government security is lower as compared to commercial loan. So risk weight comes down. Credit risk comes down. Credit risk comes down. Liquidity goes up. And maybe this is a temporary measure. The bank is doing this only for a temporary period when they are finding that recessionary situations are going to come. So recessionary situation, corporate defaults rises, small businesses may not be able to pay. So we are doing it right now. Once the economy turns up, once they show signs of the economy turning up, we'll once again swap it back to commercial banks. So we believe that the benefit of lower risk, okay, outweighs the loss of lower income. The benefit of lower risk, lower volatility outweighs the loss of income, and therefore net from a market perspective, the market value of equity will rise. The share market will say a thumbs up. Okay, so that was this particular mini case A. Okay, that was this mini case A that we have done. Now let's go to mini case B. Okay, let's go to mini case B, and here we go to mini case B. Just one second. So this is mini case B. Let's read it and do it as nicely as we did mini case A. A medium-sized insurance company plans to sell. A medium-sized insurance company plans to sell a large portion of its diversified fixed rate investment grade rated securities in order to redeploy proceeds into a special purpose trust holding a diversified portfolio of automobile loans with original loan lives of 5 years. So I see the opposite of mini case A. In mini case A, there were loans and we were redeploying that money into government securities. Here, we have fixed rate diversified investment grade securities, of course not government securities, and we are liquidating them and putting the money into securitized portfolio of automobile loans, securitized portfolio of automobile loans. So basically, you have your payoff, which is dependent upon how the automobile borrowers pay up, and their original loan life is 5 years. But we know securitization, what happens? There's a prepayment risk. Apart from credit risk, there is a prepayment risk because those loan providers prepay. Their cars can meet with an accident, they will prepay. They want to replace their car, they will prepay. Their income has gone up, they will prepay. They are shifting their location to somewhere else, their jobs are changing, they'll prepay. They get married, they'll prepay. They get divorced, they'll prepay. So they prepay, na? So because of which it becomes difficult to exactly know what type of payments will come. Okay, even if the original loan lives of 5 years, what will be the profiling? How will be the prepayment rate? That is very, very difficult. Okay, we know this background, so such that it's difficult to comment upon what will happen, in what manner they will prepay. Okay, modeling is required. Loans are collateralized by direct liens on the vehicle. So we have a lien on the vehicle, which means the credit risk is low. If the person who has taken the automobile loan does not pay the amount, we have the right of retention. So they're trying to say the credit risk is curtailed. And the underlying borrowers meet minimum consumer credit scores set by National Credit Rating Agency. So they're trying to say these are not subprime, these are prime borrowers. Okay, these are prime borrowers. And the underlying loans were randomly selected for the trust. So they're not concentrated, they're randomly selected for the trust. And the collateral constitutes a nationwide sample of automobiles of different foreign and domestic manufacturers. So the entire second part of the language was trying to say these are prime loans, diversified loans. Don't worry too much about credit risk. Of course, the economy cracks down, credit risk may happen, but otherwise they are well diversified. So our existing portfolio was a diversified fixed rate investment grade securities portfolio. This one is also a diversified securitized portfolio of automobile loans. But still, these are loans, less liquidity. Those were investment grade bonds, more liquidity. So I sense a fall in liquidity, just opposite of mini case A. There's a fall in liquidity. I also sense uncertainty resulting from prepayment risk. Uncertainty resulting from prepayment risk. So I'm not able to guess over here the duration profile. I don't know what will the duration profile be. In the last question it was okay, but over here because of securitization, what will happen to duration profile, I don't know. I think income will go up because you're going for securitized instruments, they'll provide a higher yield. I think risk will also go up because you're going for more credit risky. You may argue that credit risk is less. They have told now that they are prime and they are diversified. That's okay. But compared to the risk of fixed rate investment grade related securities, I think securitized instruments, automobile loans will have a higher degree of risk and higher degree of uncertainty regarding the prepayment. So that's my first opinion. Let's look at the question. Question number 1. What does this transaction reveal about the regulatory capital of this insurer? What does this transaction reveal about the regulatory capital of this insurer? Okay. So they are trying to say, was the regulatory capital of the insurer prior to this transaction healthy, or it was like at the brim? So anybody who is taking a higher level of risk, please understand, anybody who is taking a higher level of risk, it means he was capable of taking the higher level of risk. Na? This insurance company is sitting on fixed rate investment grade securities, liquid securities, investment grade, and it is going to a securitized instrument. It knows that regulators will demand a higher risk weights on the same, their capital requirement will go up, but that means they are already sitting on a cushion. If the capital to risk weighted asset ratio requirement is 10%, it seems they are sitting on 16-17%. So even though, 16-17%, that is higher capital they have. So even if the risk weighted asset go up, okay, so in that case their capital adequacy ratio may fall to say 13%, 14%, they're okay with it. Understood? So the fact that they are going for a risky thing, it means that they are sitting on cushion. That means existing right now, their capital is more than what is required by the regulators right now. The capital is more than what is required. Question number 2. What key information must the insurer know about the automobile loans held by the trust in order to manage its asset liability duration profile? What key information must the insurer know about the automobile loans held by the trust in order to manage its asset liability duration profile? So they're trying to make us tell them that, see, these are automobile loans, they can prepay. At what speed they will prepay, we don't know. Okay? If they prepay at a faster speed, duration of asset would fall. If they prepay at a slower speed, duration of asset will rise. So they're trying to say that, look, duration of asset is a flux over here. And based upon the fact that there was a certain duration of asset of the fixed income portfolio, and now this duration, whatever you calculate by the model, if it is not equal to the prior duration, there was a certain duration of the fixed income investment grade portfolio, and now you are going for this. So this duration, whatever you calculate, if it is equal to that, the duration profile remains the same. But if the securitization has a higher duration, in that case, your duration risk has risen. You need to hedge it by derivatives or by adjusting your liability. Or if the duration of the securitized is lower, in that case, maybe you want to hike it with the help of derivatives or with the help of liability adjustment. Okay, that's what the question is. The question language is difficult. Third, what external factors might the insurer need to consider with respect to the duration of the trust assets? What external factors might the insurer need to consider with respect to duration of the trust assets? So I'm not able to figure out. Let me see what the answer is, because there could be any number of factors, threat of recession and all that. The insurer must be concerned about an adverse change in the economic cycle. Yeah, external factors, adverse change in the economic cycle, then the defaults will rise. Change in technology, if everybody goes for EV vehicles, electric vehicles, so obviously they will prepay this loan and go for electric vehicles. And or energy prices, if oil prices rise or fall as they do, in that case also maybe they will shift to some other mode of transport. So all that will determine. So external factors, common sense oriented. So I was a bit jittery, I didn't know what to write. I thought that should I write all the common sense, so I just thought that it was not related to the text, so it was more of a holistic question. Okay. And what's the fourth question? What is the expected impact from the proposed investment transaction on the insurer's earnings? Will rise because securitized instrument will provide a higher income as compared to the high grade investment grade securities. Rise. B, overall volatility will also rise because we are going to illiquid things and with more credit risk as compared to what fixed income securities have. So I think the risk profile is rising, and volatility is rising, and return is also rising. So the question is, to some extent, the opposite of mini case A. Okay, to some extent. Okay, let us go to the third one now. So this is mini case C. Floating rate securities paying a fixed spread over the floating MRR are trading at historically narrow yield spread over MRR. So that means floating rate securities are in high demand. Their prices are very high, such that the yield spread that they are paying is very minuscule. So it's MRR plus a very low spread. So if you're buying them, you're not going to earn a lot of spread. In addition, issuers of these securities tend to be concentrated disproportionately in small number of industries, notably in banks, insurers, and other financial service companies. So who are the ones who are issuing such securities? Banks, insurers. This is one type of issuers issuing them. A bank's investment manager means portfolio manager, considers selling the bank's portfolio holdings of these floating rate securities. So there is a bank which is holding these securities. So the investment manager, portfolio manager is deciding to sell them off. Good decision. Which have a 5-year holdings of these securities which have a 5-year maturity and trade at 0.1% over MRR. So the bank is holding floating rate securities issued by other banks and providing a yield of MRR plus 0.1, only 0.1. Please focus. The proceeds will be used to buy more diversified, in terms of issuer type, investment grade fixed rate securities that are selling at more normal spreads versus government bond yields of comparable duration, which trade at 1% over 5-year UST bond. Okay, so this money will be invested in fixed rate securities which are paying treasury plus 1%, So I am afraid because they are going from floating to fixed. That means duration risk will rise. They are going from floating to fixed, so duration of asset will rise. That's what is alarming. Otherwise, everything is perfect. They are now getting treasury plus 1. They are not concentrated in the banking sector. Okay. So everything is perfect. Okay? The fixed rate securities portfolio is to be combined with pay fixed receive floating interest rate swap under the standard mark to market collateralization terms. So they are not increasing the duration risk. How? Because now they have bought fixed rate securities paying them treasury plus 1. So they are now going to enter into a swap in which they will pay fixed and receive floating. Pay fixed, receive floating, plain vanilla swap. Regulators like plain vanilla swap. Okay, with collateralization, beautiful. Regulators would be very happy with it. So they will start getting MRR, they will pay treasury. Okay. The 5-year interest rate swap terms permit one to receive MRR while paying 0.4% over treasury. So in this swap, they are paying treasury plus 0.4. Remember, they were receiving treasury plus 1. They are paying treasury plus 0.4. So 0.6 is left and they are getting MRR. And they were paying MRR over there. Okay, perfect. So ultimately, they were earning MRR plus 0.1 earlier, and now they are earning MRR plus 0.6. I'll just draw and show it to you. In case somebody is not comfortable, I will just draw and show it to them. Just wait a moment. Okay. See, this is the bank. It was holding MRR plus 0.1% of other banks and insurance companies. So concentration risk was there, low yield was there, low concentration risk. If you want to draw, you can draw. Because you may think that you will remember everything, believe me. If you study later, you may find the language to be very tough. I'm not understanding that way. Okay, we're talking about this bank A over here, bank A. Now, what are we doing? Bank A is selling them off, so that's gone. And instead we have diversified issuers. Fixed securities paying treasury plus 1%. And then we enter into a swap. So this is a swap bank in which we are paying treasury plus 0.4% and we are getting MRR. So can you see this? So on the whole, what are we earning? We are earning MRR plus 0.6%. What were we earning earlier? MRR plus 0.1%. So now it's 0.6%. Here it was 0.1%. Of course, there is counterparty risk. Depending upon the credit quality of the swap bank, regulator can have some concern towards it, but then it's collateralization. They've done it with collateralization. Okay, and then it's a plain, simple swap. So it's a plain derivative with collateralization. I don't think regulator should have a lot of concern over here. Our concentration risk has been reduced. Okay, I'm all in favor of it. Very good decision. Very, very good decision. Because if the entire financial system collapses, obviously these banks and insurance companies, even if they don't default, the prices may go down and the bank may lose, okay, of those floating rate securities. Because you know the floating rate securities always do not stand at par. If the credit rating of the issuers fall, in that case, obviously, people demand a higher spread as compared to 0.1, and therefore the price of the floating rate security falls. So coming back to the example, just one second. Let me just close it off. Okay. So 5 questions are asked over here. Okay, 5 questions. Question number 1. What does the portfolio alteration do to the required regulatory risk-based capital? I would like to read the second, third question before committing everything over here. Question 2. What might indicate that the bank's senior managers are more concerned about risks to equity capitalization than our regulators? Beautiful. I like this question. I'll come to it. What is the expected effect on the bank's asset liability profile, duration profile? Question 4. What is the expected effect on expected earnings will rise? Sure. Number 4. Earnings will rise because instead of MRR plus 0.1, we are earning MRR plus 0.6. Number 5. Summarize the rationale for the portfolio alteration. Rationale, you are reducing concentration risk, you are increasing your income. But everything cannot be like win-win situation. So I think question number 1 and question number 2, they're talking about regulatory capital versus bank senior managers. See, I don't know if you have done it somewhere. There is something called economic capital, there is something called regulatory capital. Regulatory capital is what is required by regulators as per Basel norms and the local regulations. Regulations always have a lag. They always tend to lag what is really required. Economic capital is the senior manager's understanding of what capital actually they should have in the business to ensure that they can cushion unexpected losses. So I think regulators may not be smart enough to understand that concentration risk is coming down, and therefore they should appreciate this and require the bank to keep less capital. I think regulators will not understand the fall in concentration risk. But the senior managers are so smart, they are thinking that even if regulations don't understand, we are understanding that there's a concentration risk if we are holding the securities issued by other banks and insurance companies. Okay, so we should come out of it and go to a more diversified portfolio. Of course, in order to do that, they had to enter into a swap and all, because of which counterparty default risk arises. So regulators may actually increase the risk weight. So question number 2, the senior managers seem to understand concentration risk, which the regulators are perhaps not understanding. Okay. Question 3, what is the expected effect on banks' asset liability profile, duration profile? What happens? It was floating, it is still floating. So duration profile remains same unless or until they go to this. Remember, there used to be a theorem that we used to study in level 1. Lower yield, higher duration, higher yield, lower duration. Lower yield, higher duration, higher yield, lower duration. Understood? So since the yield after this doing is higher, duration is lower. Earlier the yield was lower, duration was higher. Now the yield is higher, duration is lower if they go to that. Otherwise, I would like to maintain duration profile remains unchanged. You check the answers later on, please. The rationale I've already discussed. Okay. So we'll come to the last mini case, is it? Yes, this is the mini case 4, we are coming to it. Okay. In the aftermath of the prolonged financial turmoil and recession, so I think this is connected to what's happening right now. Suppose after 4-5 months, everything is over. Okay, a vaccine has been discovered and people are okay, they are now leading the normal life. So in the aftermath of a prolonged financial turmoil and a recession, a large pan-European life insurance company believes that corporate debt securities and asset-backed securities are now very attractive relative to more liquid government securities. So the prices are still depressed, people are still going for government securities, and the yield spread on corporate debt securities and asset-backed securities is very high. The yield spreads more than compensate for default and credit downgrade risk. So the spread is very good. Interest rates for government securities are near cyclical lows. So if they invest in government securities, they'll get nothing, peanuts. But if they go for corporate securities and asset-backed securities, the spread is very healthy. Insurance companies concerned that rates may rise and that as a result many outstanding annuities might be surrendered. Now people don't understand this language. This language means that the insurance company has sold lifetime annuities to people now. Okay, so retirees and all. So if interest rate goes up, those retirees will surrender their annuities. They'll ask for money. Okay, and where will the money be paid from? Especially if interest rate goes up, its fixed income asset side goes down. So the assets have gone down, we have to pay the liabilities. So there will be a terrible situation if it happens. So they're afraid of interest rate rising. The insurers believe the probability of a large adverse move in interest rate is much higher than is currently reflected by the implied volatility of traded options and government security in the Eurozone. Tough language. They are saying that, the IV of the options, the IV implied volatility of the options is supposed 24%. But they believe that the probability that interest rate will rise adversely is much higher than what is reflected in the IV. That means we should buy options. Options are cheaper. IV indirectly reflects the price of options. So the probability of adverse rise is much bigger than reflected by the IV of options. So options are cheap. You got to buy options. Insurers, regulators, capital and reserves are deemed to be healthy. So they are having they can take risk. They can take risk. Question number 1. What are the consequences of lowering allocations to government securities and raising allocations to corporate and asset-backed securities? So if you are reducing government securities in your portfolio and going for corporate and asset-backed securities, number 1, what will happen to credit risk? Rise. What will happen to liquidity risk? Rise. What will happen to interest rate risk? Interest rate risk. Let me think. More or less it will remain the same, but since government securities have a lower yield, therefore duration is higher. Corporate securities have a higher yield, duration is lower. Interest rate risk will come down. I repeat, credit risk will go up, liquidity risk will go up, interest rate risk duration will come down. Why? Because at a higher yield duration is lower. So is it okay? So credit risk will rise, liquidity risk will rise, interest rate risk will go down. Why? Because duration at a higher yield is lower. Okay. Of course, since liquidity is falling, it's really dangerous because they have to pay the surrender value of the annuities. They are expecting interest rate to rise. So that's a thing that they have to play with. Are there steps that the insurer should take on the liability side? What should the insurer do on the liability side? So the insurer should buy put options on government bonds. Put option, so that if interest rate rises, bond price falls, and on the put option they can make money. Anyways, the options are cheap. And they can also go for pair swaption. Pair swaption means right to pay fixed, because they are wanting to gain from a rise in interest rate. So they should go for a pair swaption. Okay, so they can buy pair swap, they can buy pair swaption, they can buy a put option on government securities. So how did we know this was the answer? Because towards the end of the first of the paragraph, they had written about the fact that options are cheap. So you have to think about options on fixed income securities. Okay. So these were the 4 mini cases. I am exhausted, to be frank with you. And in this part 1 and part 2 video, in both of them combined, I have tried to give my level best in explaining to you the entire asset liability management framework of banks. Number 1, it will help you to answer the question. Number 2, if you have the knowledge of this comprehensively, it goes to your mind and heart. Believe me, you can make a very good, investment decision maker, portfolio manager in banks and insurance companies. So you should try your luck in making a career over there. Okay. So this is what during the lockdown I have for you. If I feel tactical, I will also share further videos of level 3 with you. Thank you. Stay safe.